All right. So the two things I'm thinking about are, one, how to get some extra margin in the account, particularly IRAs, retirement accounts, because you are not allowed to get margin from the broker. Two, how to capture a higher strike, in other words, more extrinsic, without blowing yourself up, right? Because you don't want to get so close to the sun that you get burned, right? Don't get too close to the sun. Okay. Can everybody hear me clearly?
Yes.
Okay, good. I should have asked. All right. So, and this is definitely an open session, so it's not just for me to speak. But what I was thinking on point number 2, I'll go with point number 2 first because it's probably more relevant to everybody. Now that everybody's got the hang of doing this every week, as you realize, the Holy Grail is capture the max extrinsic without losing money, right? Losing money, I'll define losing money as losing money is your net liquidation value goes down by expiration. Okay, that's losing money in your account. You lost money then. So you don't ever have to go to cash. It's just that your liquidation value, as if you went to cash, has declined in the time period you're doing the trade. So we're trying to not lose money, but we're trying to capture more extrinsic, because if you get more extrinsic, your account value goes up more. In other words, you have a higher percentage return, on money invested, right? Okay, so, I am legendary for being super conservative, right? So I am always deep in the money. And always, we can cover why in this call for those who don't know, but I think we've had a lot of explanations in the group of why I go deep in the money. The reason is I want to make money. I want to make money consistently. I don't like losing money. I want to be able to make money even when the market goes down. So we all know that you make money in covered calls when the market is flat to up. That we all know. But how do you make money even when the market goes down? The answer is have a deep in the money covered call. So the reason this protects you in down markets is because you have a lot of intrinsic value in the call that gets eaten up during the downturns. Okay, so that's why I do deep in the monies. Does everybody get that? Why I do deep in the monies? Nobody has any doubts around that? So I give up upside so that I make money more consistent. There's no free lunch, right? So I have to give up something for all that consistency. I'm gaining consistency, but what am I giving up? I'm giving up upside. I'm giving up extrinsic. Deep in the monies have very low extrinsic value. Deep in
I guess you're balancing out the risk versus what you're getting back.
Very, very low extrinsic value. What did you say? Who was that?
What I'm saying is you're balancing out the risk versus the rewards that you're getting.
100%. 100%. Who was that?
This is Mustafa.
Mustafa, you got it right. There's no other place in the world, as I know it, and I'm 45 years old, that I've seen that you get to so precisely balance your risk versus reward on a precision surgical lever, as if you're doing surgery with lasers. You know, no other place in the world that I've seen it. If you've seen a place, let me know. But I know no other instrument in the world that lets you slice and dice your menu of, I like this reward and I'm willing to take this amount of risk for it. No other place. There's a strike for every personality in this world. There's a strike for every person.
Yeah. And that's why with the volatility in the last few weeks, I mean, I've been sort of going down to maybe 10% of the strike price. So deep in the money, not as deep as you do, but if the market is at 140 on the TQQQ, I would take 10% to 1.
You got cut off there. That was a very important point. Please say the last point again. Mustafa, you got
I'm saying, yeah, okay.
You took 10% of your portfolio and you did what?
No. What I'm saying is that if TQQQ is trading at 140, what I would do is I would sell at 10% below the strike.
Got it.
I go at 125.
Amazing.
Yeah,
I love it.
So this way you have a 10% protection.
Buffer.
And again, and like you said, no, you're giving up some of the extrinsic, but hey, at least you'll get something.
You're getting consistency, right?
Yes.
Yeah. So we all have different goals. Some people want to shoot the lights out, as the expression goes. I have no idea where that expression came from, but they literally want to shoot the lights out. So that means like you want it all. You want everything you could possibly get out of upside. Fine. Don't go deep in the money. Go out of the money if you want that. Go out of the money when the technicals show you we're going to explode higher every time. Go out of the money every time we dip. Go out of the money. I went out of the money. So one thing that you need to remember is we don't have to be doing the same delta every time. So I'm a deep in the money guy. I am known as a deep in the money guy. I'm pretty much almost always deep in the money. Almost always deep in the money. However, that being said, sometimes I am at the money and rarely I am out of the money. Now, those rare moments are phenomenal moments. When I'm right. When I'm wrong, I wish they never happened, obviously. But so the last time I was out of the money, there were 2 times I was out of the money. One time I was naked during this pandemic. So I'm just going to do 2QQ. Let me pull up the chart. Okay, can you guys all see my chart on Thinkorswim?
You're good, yes.
Okay, great. So I'm going to zoom in here. Let me get rid of, I don't like volume on my charts. Maybe it's here. Okay, better. All right. So, pandemic. So I was, I'll be honest. I was in cash a lot of this time right here. I mean, I missed all this upside. I was in cash most of this time. I was one of the doomsayers saying, you know, we got to sell off sometime, but I had no idea we're going to hit a pandemic or anything like that. I was just thinking we'd been up for forever, and so I want to be in cash. I was too conservative. I missed all this upside. However, I didn't catch any of this downside because I happen to be in cash. I got sick around here late February, early March, so I was very, very sick with COVID around this heart of the margin calls, heart of the limit down days. I was just sick. So I wasn't paying attention that much, thankfully. Then I'll never catch the bottom. I won't know the bottom until after the fact. So I kind of got better, woke up, and I was like, looked around the world, and then I was around here. And you can check the WhatsApp messages. And I got in. I got in naked. I got in naked. So this was one of the few times in my life in this position that I got in naked. And I got in naked around the 50s. And then I rode it to the mid 70s, I'd say, to 80 up here. Like somewhere around this, approaching the neckline right here. And then I started doing covered calls because I wanted to protect all these gains right here. And, you know, we had reached these minor highs. So I was thinking, you know, get a little more protective. And so that was the last time I was naked in this pandemic, was right here. Then I was covered for all of this. The second time that I didn't do deep in the money, I was doing at the monies when we started out months ago. That was what I thought was the best because you capture the most extrinsic, but I didn't like losing money. So I told myself, all right, let me go deep in the money so I can kind of protect myself on these moves right here and here. So I was deep in the money for the rest of the time. I happen to again be in cash. No joke. People have my screenshots. This was ridiculous to me. I had no idea how to pick a strike, so I just gave up. Like I gave up and missed all this. I had no idea what strike to pick. It was just too close to get a deep in the money. It was just too close to get any extrinsic around this crazy time. So I happened to be in cash the Monday before that crash. I wasn't in cash like this day. I'm never that guy. I was in cash a couple of days before, maybe a week before, you know. And so I missed this. I got lucky. And then down around 108, no, 112, around, not the, I wouldn't say it's the bottom day, but maybe the day after something, or the day before the bottom, like 112, I went out of the money. It was like going from 108 to 112. I would say maybe it was this day. It might have been this day. Went down to around 108. Yeah, the low was 108. Then went up to, yeah, so it might have been the day right here. But we did hit that again later. So this day, when it was around 110, I took out of the monies at 115. I didn't know it was going to be the bottom. We actually had to retest the bottom right here. But this was a rare time where 175 to 108, at some point you got to say enough's enough. We have some support down here on this left side. So I went out of the money again, rare time. I was naked here and then out of the money here. So those are the rare times I took a little bit more. But my problem is the whole position was naked, which is kind of dangerous. And the whole position was out of the money, again, which is kind of dangerous. So what I wanted to share with you guys is I don't have to, when you want to take a little more risk, and the key is little more risk, I sail. So in sailing, you don't want big adjustments. You want minor adjustments. So the boat might tip over. You might catch too much wind. You might lose all the wind. You might turn too fast and hit wakes. You don't want to do big adjustments because you'll be all over the map. You want to do little adjustments. So if you want to take a little more risk, then move to a higher strike, but don't do it.
Doug, we can't see your screen.
Oh, sorry, you can't see my word. Hold on. Stop share. My bad. Good call. Thanks for reminding me. Here we go. Okay, so now you can see my Word doc again?
Yep.
Okay. When you want to take a little more risk, then move to a higher strike, but don't do it for the whole portfolio. That's one thing it took me a long time to learn. If I had known that, or I knew it, if I had forced myself to think about it more, I would have been capturing much more upside from 2009 to 2020. I was the kind of guy where I'd be all cash or all in, and nothing in between. But you get to kind of have your cake. You kind of get to have your cake and eat it too when you think about portfolio construction, portfolio allocation, goals, a little more money, a little more profit. Number 2, don't lose sleep at night over getting that extra money. Okay, those are the two things we are trying to balance. So how do you do that? Only take extra risk with a caps lock this if I can figure it out. Proportion. How about a small proportion? A small proportion of your portfolio, right? So if you want higher strikes, if you want higher strikes, just allocate 10% of your portfolio to higher strikes. This way you get to participate in higher risk, higher reward, but you don't lose sleep if it doesn't work out. One more thing you could do, one more adjustment you can add to taking that higher risk, higher strike, is what Arsalan said. Throw in a long put out of the money to protect that higher risk position. So two things are protecting you. Two things are protecting you. You're going into battle, but you're going in with heavy armor. Okay, you're going in with the cavalry behind you. Two things are protecting you. One, it's a small proportion of your portfolio. Two, you could get added protection with puts. And I'll give you one other thing. One last thing. This is like 700 level. This is master's level. Master's level protection. This is very complicated. Sell higher strike call spreads above. Give up some upside that is unlikely to happen. Okay, so then you'll collect a little more premium. Collect a little more premium to buffer the extra risk you are taking. So the view here is, look, I want to get closer to the action, but I don't expect the action to go parabolic. So because it's not going to go parabolic, hyperbolic, I'm willing to give up, if I'm in TQQ, I'm willing to sell above, I don't know, arbitrarily. I'm not looking at the ladder right now, but let's say I'm willing to sell above 180. I won't capture any of that upside, but I'll use that to protect trying to get as much juice as I can from 140 to 150. Okay, that's a little complex. It breaks your brain at that point, but these are all methods to get closer to the action, but to have like the cavalry behind you, have like armored tank, have like, bulletproof vest while you're going into the action, all right, so any questions on that, and questions and comments, and I hope that if there are questions that some of the people in the group who are getting it can answer some of the questions of the other people in the group too. Go ahead. If you have comments, make your comments. If you think I'm missing something or want to add to it or do it a better way, let me know, because I'm only seeing one way to do it. And if you want to answer the question of somebody else, let me know too. Go ahead. The floor is open.
Javed, one question about, you also go far out. What's the logic for that?
Oh, yeah. Okay, so that's good. Who was that?
This is Sunil, Javed.
Okay, Sunil. I'm going to answer that today, but I'm going to table it so that we just don't lose track of what I just covered, and then I'll come back to what you said. That's a very good question. People have been asking that for a while. So I will cover that next. But let's if anybody have a question on this aspect of, so okay, I'll give an example to make it real. I am kind of permanently in 115s, and by the way, 115s were out of the money when I entered it, so I made a ton of dough on this position already, getting it to be deep in the money. It wasn't deep in the money when I was in, but I'm in 115. This is very far away from the market at 141, I think. So what I'm thinking is I will take 10% of my portfolio and go to, it doesn't have to be at the money. Let's say 130. I was talking about 130 later in the week. And let's say it crashes to 125. Who cares? It's only 10% of my portfolio. 90% of my portfolio is very safe, So that's an example. Okay. So I think, I don't know, either everybody's completely lost or everybody gets it. If you're somewhere in between, please speak up now. You can always ask your questions in the group, in the WhatsApp group later. You can, this document obviously will be sent around. I'll post it in the WhatsApp group. And I'll post the recording there too.
You're saying you're permanently 115, meaning that's your average cost right now?
No, that's my strike.
Oh, okay.
My strike. Oh, that's a separate discussion. Okay, hold on. So I'm going to put some topics down here. Topics to cover one day. These topics come up all the time. Does cost matter? I have a very unique philosophy about cost. The other topic was why roll out? Why roll so far out? Okay, yeah, topics to cover.
Walaikum Javed.
Yes.
Could you zoom in to page width, please?
What's that? Say again? What?
Could you zoom in to page width?
Okay,
please?
Let's see. How do I? Can I give you? Can you do that for me? Where do I go? Just talk me through it. View?
Click on view.
Yeah.
Say page width.
Okay, I'm gonna learn something new today. I'm trying to find multiple page width right here. Page width. Oh,
Thank you.
cool. All right. I should explore those banners one day. This Microsoft changes this thing so often. I just gave up a couple of years ago and tried to learn all the new things they have up there. Okay. Thank you. I appreciate it. I'm going to use that skill. That's good. Thank you. I appreciate it. Was that Shoaib?
That is correct.
Okay. Thank you. This is so much better, so much clearer. All right. Great. So everybody got what I said? I'm getting better at explaining things if they did.
Javed, this is Zane. I just had one question. What it seemed like is basically you were just hedging your position by taking the opposite side of your trade. And when you were trying to increase your risk parameters, you were doing it with a significantly smaller portion. It seemed like you were just basically like every time you took one step out further, you kind of took one step to hedge as well.
Yeah. Yeah. So, yes. So it's like you want to participate a little bit more, but you're afraid that you're going to get burned. So if that's the case, which is the case for almost everybody, you see the action. You know, I've been posting some curves, right? Like some distribution curves out there, distribution of where all our strikes are. And you see these guys, they killed it this week. Whoever is at 140, hats off to you. You know, whatever you saw, I did not see, or I saw it and I didn't have the guts. So you crushed it. So, you know, I was like, well, how can I crush it a little bit more? Like that guy, I want to be a 140 guy, but I don't want to blow up my portfolio trying to get there. So let me tiptoe into the 140s. If it works out, hey, I got a little bit extra juice for that week or that month. But if it doesn't work out, hey, I didn't really notice it because it was only 10% of my portfolio. Who cares, you know? So, I mean, it's more to fight the psychology more than anything else. And also maintain the consistency in your portfolio. Because I think consistency keeps us in the game, keeps us psychologically grounded. As they say, you gotta, you know, stay in the game to win it. Trading is a stay in the game kind of sport. If you can't stay in the game, you're out, you know? If you have no money to play, you're done.
One question here. How much are we using technicals and fundamentals here?
So, that's another question. Technicals versus, it's a very good question. All these are phenomenal questions. Not that there's any such thing as a bad question, but these are extra good questions.
100% versus 0%.
Okay, I'll write that. Hold on.
I mean, at least that's what I use.
Yeah, that's me. Now, the problem with kind of learning or getting new perspectives from somebody who's a little bit of an extremist, that's a little dangerous. So I'm going to title myself as an extremist in the technical versus fundamental schools of thought. And that's dangerous. So let me just be fair and say, you know, don't ever do what I do. Just take it as one perspective. And, you know, I encourage you always to build your own perspective. And that's why I do these calls, because I'm trying to learn off of you guys. I could be in this sport for a couple of lifetimes, and I guarantee you I will always be learning something new, because this is much bigger than a lifetime, this game. There's no way in like 70, 80, 90 years you're going to learn all you need to know. It's just impossible. So the market is too deep, too wide, too many people involved. Everybody affects the market every day, so you're never really going to know what you need to know. But you try to pick up what works and call it a life. So that's a big discussion right there. It's a very good.
One more question here to add, Javed, is also the position is also critical, right? If somebody's owning 2 contracts versus somebody's owning, say, 100 contracts.
Number of, positions, like absolute minimum number of contracts, let's say. Yeah.
Because your risk-taking ability will be very different.
Let me write that. Risk-taking ability is completely different. Yeah, I mean...
That's a very valid point, yeah.
It's extremely valid. So, I mean, I hate to say this, and sometimes I'm harsh, but this becomes not a game for someone who can only afford one contract. So, I mean, because by only having one contract, you limit your ability to win consistently. Because you cannot do what I just described. You only have one contract. And the other thing you cannot do, you know, when you have one contract, it's okay to have one contract to learn. But when you have one contract, you cannot do the following.
Usually what happens is that those who own one contract,
Yes.
they typically see a value in the stock itself than the covered call. I mean, that's a mindset.
Yeah, you're right. You're right. It's better for them just to own the stock. Yeah, you're right. One thing is you cannot chase the stock. As soon as it moves higher, you cannot roll. You have no money, right, to buy it higher. And number two, you cannot diversify your risk across. I don't mean diversify across instruments. I mean diversify across strikes. You know, so you can't do those things when you have one. So one is okay to try and learn, but it's really hard to get consistency with one contract because stock moves up, you can't play anymore. You're done. And you can't take different strike levels either with one contract. So one contract is tough. So since we have all these other topics, I'll try to cover them all if there's no other questions on diversifying your risk by small.
Javed, Rajesh here.
Go ahead.
Yeah, sorry, it might be a very basic question since I'm a beginner. So you said permanently 115 strike. So that is the basic covered call strategy to have like a 20% out of the money or in the money. And then the 10% portfolio is the new strategy that you're explaining today.
100%. It's good to clarify what's going on and not take it for granted. This was old strategy of 100% of my money.
Okay. And what is the, is that a 20% below the current price? Is that the strategy?
Honestly, it was, sometimes I seem like I'm more scientific than I am. It was the human in me. I was just pissed when it went under 110. And I went out of the money at 115 and I never looked back. So I know you want a scientific answer to how I came up with 115, but it was a revenge trade. Sometimes you just got to be honest, right?
Okay.
I got in at 145, as everybody publicly knows. And I wrote it down and rolled down and lost like $100,000 getting down to 110. And I said, fuck this shit. I said, fuck that shit. And I threw everything at it and went out of the money. And I was like, I'm not going to look at the market until it goes past this 115 strike. I was like, I wanted to throw my laptop out the window. That's how I came up with 115. It was the throw your laptop out the window moment.
Okay. And about
you asked, so I had to tell you, right?
Yeah, no. I mean, I think probably it's more like experience and more intuitive, like based on where the market is, and then you probably come up with that number, right?
It was, yeah. I mean, you're being nice to me. I appreciate that. You're making it sound nice, which I appreciate. I used to talk that way about myself. I don't give myself that much credit. Honestly, sometimes I just get really pissed and I'm like, enough is enough. Another way I looked at it is we lived down there for a while, like 110, 115. Those used to be my old happy strikes, 105. So I'm like, we finally came back down here. And the pre-normal world was, down in the 80s to 50s. And I thought, and this is where I'm going to break my code. I thought a little bit fundamentally. I was like, the world outside doesn't look anywhere like the world looked at in March, April. And so why should it go back to March, April levels, you know, and so, or May, June levels. So that was a little bit fundamentally thinking. So I'll admit yeah.
In fact, 115 was a good support. 117 was a very good, strong support.
Let's go
And
back
because-
there. Let's go back to the chart. Hold on a sec. Hold
Yeah.
on a sec. Hold your thought. Hold your thought. Hold your thought. Let's go to the chart then. Hindsight is 2020, but let's go for it. So tell me, who was that? Sunil? Who's talking?
Yeah, that's me.
Okay, Sunil, say it. Yeah. Can I give you control here?
Yeah, no, I think I just say I looked at 117 as a pretty strong support because that was pretty much matching the February levels as well.
Let me look.
And because it was a leveraged fund, I mean, it's always expected that it can touch 110. You know,
You're
being
right.
the-
Right here was the peak in February. I
Yes.
didn't even realize that. That's a good
And
point.
I looked at that and I entered in early September because I said this cannot go below 117.
So as the
And
old
110,
old highs become new lows, right?
yes,
Yeah, old resistance becomes new support. Okay. Also here, you know, we had a whole
Yes.
congestion area as well, right?
and I was pretty confident. I was sharing those screenshots at that moment. That
Right.
117 is a beautiful place to re-enter in this TKQ, and 110 was expected because it's a triple X. So you can't be a precise one. So, and it just came back within a matter of a day to 118 level.
I love it. I love it. Honestly speaking, if we have guys like you who post charts like that in this room, every point of extra extrinsic we can capture will be exponentially higher returns for us throughout the year. So if we can get just a little bit of conviction around those turning points, that is what makes, you know, your trading portfolio soar. Just a little. You don't have to be right every day. You just kind of want to be right around here, around these dips here, definitely around here anywhere, you know.
And another thing which I have consciously seen is that the March drop was almost like 36%.
Okay.
Yeah. And
Okay.
the last drop that we had in September was 20%.
Excellent. So
And those
this
drops are dropping.
This drop is similar to this drop in percentage terms.
But when you really look at even QQQ wise, it's a smaller one in reality.
Yeah,
So
and
this
Q
is not like a
is
March
what you
crash.
should really be looking at, right? Q is what you
Correct.
should be looking at. So this drop is the same as this drop. You're saying percentage-wise.
No, it's a smaller one. The March was the drastic one.
It's smaller, which is what you
So-
would expect later in the rally, right?
So later in the November, I expect even smaller if at
Yeah.
all there is a correction. So
100%.
it eventually has to go up.
Yeah, you could look at the history of the QQQ. This is a big dip. Then we got a smaller dip. Then we got a smaller dip. Then we
Correct.
got a smaller dip. Then we got a smaller dip. Then we got an almost same dip. And then the big dip. Okay, so same thing since May of 19, right?
Yes. I mean,
Same
if you
thing.
really see the March recovery is a perfect V shape. And in September also, it's a perfect V shape. You know, in October,
Oh, yeah.
it's just going against technicalities.
Okay, so let me bring that up. This is my favorite technical formation. This is my favorite, the one Sunil just mentioned, okay? And Sunil knows I shared this with the larger group before. So my favorite technical formation is exactly what Sunil mentioned. I rang the bell here on April 6th because I saw a V. And I say this V is very similar to the V we saw in 2009. And it's almost a carbon copy. This V looks exactly the same shape as, if you go back a number of years, let's go back to 2009. Yeah, this V, see how it's down? Okay, so we had a little double bottom, but you go down here in 2008-9, then see how this is not as steep, it's more extended recovery, but you still hit the neckline, right? So the SPY looks even more like what we did now, right? So Here we go. Down, then extended, flattening up to the neckline again, right here. So same chart. So I agree with you, Sunil. So what I thought was when we were down here in March, that this is a V bottom. I didn't know until after the fact, like here. So I thought the place to go is we're going to end up here. So I went all in, naked, to get to here. And then I started covering, when we got into this area. And then we approached this neckline. Then we made the measured move. So getting to the neckline is my favorite formation. We got to the neckline here, here, here. And then I fully expect us to get back to the all-time highs on this V, or U, you could call it. V's and U's are the same thing. And then we did a measured move. So that's my second favorite thing to do technically. So measured move means bottom to top, we're going to double it. And I think we already did. So 170 to 230, 237 is 37 plus 30, 67 points from here, which is 304. Used to be kind of dirty. With these machines, it's fucking ridiculous, right? Did everybody just see that?
Yep.
I didn't even plan that for this call. I did not notice that the measured move played out that precisely. Usually this used to be a little dirty. I was expecting, maybe 308, 302. But sometimes it's that sick, right? This to here is exactly what we did to the high before we crashed. This is not just this chart. You'll see this on every chart. You'll see it on a 5-minute chart. You'll see it on a 1-minute chart. You'll see it on a tick chart. It's the same thing. Measured move, you could go back decades and you'll always find the measured move on the chart. But the place it's most consistent is the daily chart because it's a slow chart. So you knew back here that someday in the future we had to get up to here. And ironically, that's the day we crashed too. We did our work, got up to where we needed to and crashed right after. So now we got to get back to 303, given that 261 to 303 is 44 points. 261 to 303, 42 points? No, 42 points. So 42 points above this is where we're going to go after we hit the neckline. So 345. So you guys remind me when we hit 345 that we called it early. So that's how you can tell the future. But that was getting off track a little bit.
Joey, while you're on, just quick clarification for me. When you said that initial portion, you were naked. What do you imply? What are you saying by that? You were doing naked calls? You were.
Oh, sorry. Yeah. So when I say naked, it means I was naked to stock.
Oh, okay.
Yeah. So not that bad. Yeah. I will not be known to do naked calls. I mean, look, just as adding to what we just discussed today, I mean, if you have an edge for gambling, if you have this itch for gambling, you could take 5% of your portfolio or something like that and just throw a flyer out there when you have conviction. I mean, if you guys get good at these technicals, I fully expect you guys to throw up charts in this room, just like I did today. Post the chart, draw on it, draw lines on it, write letters and words saying we're going here. Nobody will fault you for being wrong. If they do, they can talk to me about it. But I'll be the last guy to fault you for being wrong. I'm wrong more than anyone out there. But I put myself out there as often as I can. So if you can tell us, look, we're headed here. We're going to take a little more conviction. And we'll get a little more aggressive and we'll make a little bit more money together. I'm happy to be naked coming out of pandemics. Even if we were going to revisit the bottom. I still was happy being naked. If I was a little more thoughtful, I might have taken a little bit more risk at that time, which leads us to the second part of the discussion. Go ahead.
Javed, this is Athar.
Yes.
Just on this only. It's like as you go for a list of every week, which strike price and people are throwing, if we can have a chart on the Monday just with that range or whatever, just to get an idea, and then a discussion with most of the people, then
Yeah,
maybe people will see more on the chart and then adjust their position if they have to close it out now or be put a stop loss or something.
so you say throw up a technical chart? Is that what you're
Yeah,
saying?
yeah,
Yes?
technical daily
Yes.
charts for the week, and then
Yes.
say, okay, this is what we are going, instead of just saying, okay, this is the strike price or whatever.
Yeah. Why you want your strike, right?
Right. So at least, okay, now we are at the bottom of the channel, or we are this way, or resistant approaching. So keep your guards up at this time, and we'll watch this price range a little bit more closely. Then if it
100% agree
starts
with you.
falling, then we will close our position at this time. If it lose this position, then something like that. At least for the weekly people. I know you are in long 6 months or 4 months. That doesn't make much difference, but for the weeklies, people think we should
100%,
do this as a
Arthur.
weekly technique, right?
100%. Arthur, I 100% agree with you. We have such a rich data set, which honestly speaking, I want to publicly say this. There's no way I would have stayed with this trade unless 50 of you actually posted your trades every week. I obsess about that list because it keeps me in the trade. I knew this trade 20 years ago or 25 years ago. I only started doing this trade in the pandemic, like in a meaningful way, where it meaningfully changed my life and my net worth. So that data set was super rich, and it kept a lot of us in the trade. It definitely kept me in the trade. But what Athar is saying will take us to the next level, and I fully encourage it. If you can get yourself to take 5 minutes out of your day in 1 week and just post a chart and maybe a recording. WhatsApp makes it very easy to record your voice. You don't have to record a video recording. Just record your voice with a screenshot. Separate voice recording with a screenshot to make it even easier for you. And just say, this is my chart. This is what I believe. Watch out for this and look for this. That would be absolutely incredible. That will multiply what we can do in this group in terms of returns and the risk without taking super extra risk to get there.
George, I just wanted to also say my strategy somehow, because
Yes,
I'm a fundamentals guy actually by nature.
Share your fundamental strategy with us.
I mean, so the reason is because I'm going for the bi-weekly instead of weekly.
Okay, why?
The reason is that's allowing me to watch the news, because most of the market behavior is based on the tweets and the news. 1 week goes good, 1 week goes bad. What it's doing for me is when the market goes down, I buy back my calls. And then it allows me to re-enter next following week when the market goes up. So I'm able to play that game better in a bi-weekly than a weekly.
I love it. I think that's very value add. Here, I'll write these things down. Let me see. You guys keep talking and I'll keep writing. So I think we've got a good dialogue going now. So we have a lot of rich thoughts that came out. So anybody else wanna? Here, I'm writing what you said. That was Sunil?
Yeah, that's me. And also that gives you the not to lose the upside movement. It's also allowing me to protect my shares at a reasonably a good price, and I'm not being so greedy to take the juice either from the premium. And that's my way of play so far.
So I have hi Javed, this is Simi.
Hi Simi.
I had the opposite actually. I'm now trying to move from bi-weekly to weekly because I found, and the most recent example was this last week, where I found I lost completely on the upside because the week prior, the market, or at least the TNA, was really low. So I lost, and it suddenly rose last week. So if I had had the weekly, I think such big changes might have been avoided.
Yeah. But one thing to add, Simi, there, the Russell is behaving very differently as compared to NQ, by the way, QQQ, because Russell had been quite a consolidation area, for quite, no, I think almost for months, and it has suddenly broke out. So the behavior of TNA is extremely
Yeah,
weird at this moment.
that could be it. Yeah,
Well,
something. I mean, I just really, I found I really lost out so much on the upside. Like a lot.
I mean,
So
actually, I taught TNA to my son. He's in college, and he just played once, and he made 12% money. He couldn't get into the wheel exactly for the same reason.
see me, I lost on the other side. I was selling in this covered call. Always I have 2 or 3 contracts selling the calls. And I was hoping it will not go that much up. And it reached from 33, 39 in 1 week. And I kept on rolling and it keep pushing me. And I rolled it to the next week now. So this week was very extremely different for the TNA.
no. I had the same experience as you. I had a covered call for 32 and
Right.
went to 39. So I lost on the upside too. I mean, I'm getting a sign.
So I
Yeah,
feel
it's
it went
difficult to,
too fast
yeah,
in too short amount of time, right?
1 week
So
is,
I am expecting that it will come down in following weeks, and it will come down to the natural levels that Russell has been at, which is about low 30s, I would say.
Actually, I have one point, and this is Jadawan. I'm not technical. I mean, I'm just following the gurus, and I started, and I think I'm not 2 or 3 months doing this. I want to share a couple of observations. I would say maybe I'm not using the right lingo also, so please forgive me on that. First of all, I mean, on TNA I was doing mostly, and the same thing happened. I mean, it got assigned at 33 or something, and now I'm out of it. So I'm just selling what the opposite of it. We are doing the selling the put kind of thing. So it gave me a little bit kind of security also, not to lose money or something if something happens. And on the other side, bi-weekly or maybe a month range of calls, it helped me for TQQ. I sold for October 30th, and how the things are moving. I mean, I was able to get the juice out of it, maybe 65% of the profit. I sold it, and now I have all the cash ready for next week also, without any risk. So I'm saying, I mean, I sold for 30th for example 2000 premium, and I was able to get 1200 out of it. I bought those calls back, and I'm all set. So those are the things which mean I'm trying. But again, the people, when they share it, give me confidence and that they are doing this trade, and I try those kind of things also. So thanks a lot for sharing this knowledge for people like me who are really beginners in options.
It's great feedback. It's really good feedback. Other thoughts?
Javed, this is Ifat. I have a question for you.
Go for it.
So when you are in deep in money call, like a really deep, so what happened at the end of the week? Your share not going to call away?
Oh yeah, okay, so that's a really good question. Shares, this is my experience. I wouldn't say it's the same experience for anybody. Has anybody ever in the room here, we have 26 people, has anybody in the room been called away on TNA or TQQ in the room, ever? Not on stocks. You get called away on stocks, I get that. But have you ever been called away before expiration? I just took that for granted. Before expiration on TNA or TQQQ?
Unfortunately, that's happened to me only one, and that's my first trade.
Actually, it's fortunate, and I'll tell you why. So that's a gift. That's like a gift somebody handed you. I have to wait 5 months to make my money. Now it's 4 months, right? January, 4 months. I have to wait 4 months to make all my time value. If somebody assigns me early, that means they gave me 4 months of time value up front. I don't have to wait 4 months to get my time value. So that's a gift if they assign me. That's like $20 of extrinsic that they're going to hand me immediately.
No, I mean, when you sell covered call, so you have a share and they take it away. So we are waiting only for the extrinsic, right?
Yep. They
So-
give the extrinsic up front then.
Hmm.
They would never do that. So the reason why you got called away by somebody who doesn't know what they're doing. They wanted to give you a free lunch, and they gave it to you. But we don't
Okay.
get free lunches very often in the ETFs because people who play in the ETFs know what they're doing. Usually, it seems like. So nobody's getting assigned at all beforehand because then they're giving you the extrinsic beforehand. They're giving it to you up front. Especially when you're so far out. Nobody's going to give me 4 months of extrinsic now. They're just not going to do it.
So at the end of the week, is your share not going to called away? It's still in your
No.
portfolio.
No, yeah, it's always in my portfolio. The week doesn't matter because the week has nothing to do with my 4 months out expiration.
I think she's referring to like if she has, correct me if I'm wrong, her expiration, if she's doing a weekly,
Yep.
at expiration, it's still in the money, then it would be called away. Yeah, that's what
Yours
happened.
will be called away, yes. At the expiration, yours will always be called away.
Exactly.
If it's before expiration, you never get called away. You said it happened to you once, right, Ifat? What day did you get
that
called
was
away on?
weekly. That's like after 3 days before, like 2 days before the expiration, and I was doing just a weekly. Yeah, I mean the other person who take my word. Yes, thank you. That's what it is. I was doing weekly.
Yeah. So.
But it got called away during the week, not at the end of the week, right?
No, in the middle, like Wednesday morning. I wake up and I say, oh my
And
goodness, I have no position there.
Usually it happens with the dividend stock, but I don't think TNA gives any dividend or anything.
The TNA was.
I don't know about.
Anyway, so that's only one thing happened, and I just wanted to know, like, if it's a weekly, so end of the week when the contract expires, so they take away the share.
Yeah, at the end of the week they do, but during the week they never will, except as Uthar says, if there's a dividend paying stock, then they'll exercise early to capture the dividend, right, Uthar?
Yes, that's the philosophy in the dividend stocks, where before dividend they just pull, like, because you're selling somebody, right? So the contract says you have the obligation and the other person has the right? So if you sold somebody, they have a right to pull the stocks away from you.
Right.
That's the basic of the contract, right?
Okay,
So if
Athar
they
was my
see-
first teacher. Thank you, Athar.
So you
So
have obligation. You are telling somebody they can pull it, right? But now the question comes, why would they do it, right? So the question is, why would they do it? They have to see some benefit out of it. So one benefit is usually when people pull midweek is when they see a dividend date coming and they wanted to have those shares on the dividend day to get the dividend benefit. So that's mostly.
Oh, okay.
TNA is, I don't think there's any dividend. I don't know, but I'm just assuming.
The leverage funds don't pay dividends. The only ETF that pays dividend is the SPY.
SPY,
I mean,
right?
that's not leverage. Yeah, that's not leverage.
So
But,
maybe somebody was like just a new trader. He said, doesn't know, maybe next it will go up. I will lose my premium. So so this might happen that if he thinks that tomorrow I'm losing all my premium because he bought something, he will pull the stocks from you and now he's not losing premium. He's sitting on his stocks and maybe next week it jumped up and he made the loss. So if somebody calculated that way, then he can pull anytime. If you are selling anything, you should be ready to own it before midway. But it usually doesn't happen 96%, 99% of the time.
So that brings me to, okay, go ahead. Go ahead.
This is Rahul. I also read somewhere that if you are deep in the money and there is no extrinsic left, then also sometimes people exercise it. Is that true?
So that makes sense based on what I said. If there's no extrinsic left, you can get exercised anytime because you're not giving up extrinsic to exercise, right? So then, you're kind of neutral. You're not giving up much to give the exercise because you're not waiting for any more.
No. For a buyer, extrinsic is a negative value, right?
Okay, so then it doesn't matter. Yeah, but like for the buyer, like if they're deep in the money and there's no extrinsic left, it won't bother them to exercise because when you're deep in the money and you have a lot of extrinsic left, then you're giving that call seller all that extrinsic for free. But if there's no extrinsic left, you're not giving the call seller anything for free at that point. You're just exercising, and you're exercising and holding the stock longer as opposed to holding this call until expiration. They're kind of ambivalent between the two.
So only thing I can think of is like, okay, I buy the calls from somebody as you as a seller, right? And the week is finishing this week.
Yep.
And I will
don't want to hold the stock.
Money, like either I sell my contract and I become zero again and start from scratch, or I think this price is good. I bought this thing and now I will hold it forever.
Exactly.
So I will exercise my option because I think maybe next week it is going to go higher and I need to have that stock right now.
So I had this, that's a very good point out there. I had this discussion earlier this week with Sadiq about why even that doesn't happen too. And it all is based on opportunity cost. Okay, so and that brings me to the second part of why I had holding this call today. Why would if I'm getting a 1 delta with the deep in the money call,
right,
and I'm getting it for a fraction of the price of buying the stock,
correct,
then until expiration, there's absolutely no reason based on opportunity cost for me to spend all the money to buy the stock if I'm getting all of the upside of the stock by putting out a fraction of the money. So if I could get 1 delta of TQQ without spending $141, why would I spend $141 to get it? It doesn't make any.
Yeah, that's why I'm saying 99% it doesn't happen. Otherwise, you will see very often, right?
Exactly. So
otherwise,
it
might. Of the people would be doing it, but it only happens 1% of the time that most of the people are not into exercising these options.
Yeah, and they don't have any opportunity cost that they see by doing it, right? But most people are pretty savvy enough who are in this game of these triple levers. Nobody who doesn't know what they're doing gets into a triple lever. I noticed that from JM. Like everybody's so scared of these things that unless you really know what you're doing, you're not even going to touch it, right? So the guys who don't have any opportunity cost, the guys who have no sense of extrinsic value and giving that money away for free, they would easily do it. But those guys are rare in this game. Now that brings me to the second point, which I thought was extremely important. Athar, I think, covered this point before, which is part 2 of today. Synthetic margin. So what I mean by synthetic margin is getting margin without asking the broker for it. Okay, now how do you do that? Athar brought this up, and who's our friend from England who used to love to do this? The woman who used to trade in this group? Huma used to do this. Huma might not be on this call, but the way she described, and I'm taking it much more seriously now that I've done this covered call for a while. So instead of owning the shares, owning the stock as the underlying, you own a deep in the money call. Okay, so Athar, I think I would ask Athar you to, because you were on that call and it was a very long call too when these discussions happened. Do you have any thought? I'm seriously considering, here, I'll write it down. I am considering doing this with, let's say, 10% of my portfolio. And let me just cover one catch, which I think I saw. One catch and slash massive risk is early assignment before expiration, because if you use all of your money in this strategy, you will not, you might not have enough money to meet the assignment? Question mark. Okay, but Athar, I think I'm missing something here. So I'll ask you to speak first. Here, let me just write what I might be missing. What I might be missing, and this is a very complex way of doing this. So anybody who feels like they're lost, try to hang on or come back to this call and watch it like 5 times. But what I might be missing is getting the shares is still cheap for me to meet assignment, because, and Huma used to say this, I can exercise my long call at a low strike price because it's already deep in the money, because it is already deep in the money. So assignment is no problem, question mark. Okay, so Athar, if you're still on the call, if you could kind of tell me what I might be missing on this. One other thing, Athar, before you speak. This is synthetic way of getting leverage or margin, because you don't put up 100% of stock price in capital. You put up a fraction to play with 1 delta.
And Javed, the other term for this is poor man's covered call.
Yes, poor man's covered call. So anybody wants to Google, there should be a way to write Google this. Poor man's covered call. Okay, very good. Who said that? Who said that?
Yeah, this is Mustafa, and the reason I said it is because I do it. I do it for TNA, I do it for Apple, I do it for other equities.
Okay, Mustafa. Athar, can I ask Mustafa to speak first before you? Athar's gone already? Let me see.
I'm here. I'm sorry, I was on mute.
Oh, that's okay. Athar, can I ask Mustafa to speak before you?
Yeah, sure. Bring up the chart first.
Okay,
and
I bring up the chart and I will.
Not the option table prices, that will make it.
Option table price. Okay, let me bring the table price up.
Could you just repeat that one sentence that Mustafa said just now?
Yeah, Mustafa, go ahead. Mustafa, go for it.
Okay, basically what this is, I mean, when they say poor man's covered call is, I mean, you don't have the capital to buy the underlying stock. So what you do is you buy leaps. Now leaps are terms of 6 months, 1 year long options. So for example, I mean, if you look at Apple, what you do is you buy the one, right now you buy the 100 calls.
What month?
Going to January of 2022. Okay, so that is your baseline there. And then you use that as your underlying security, and then you sell either weekly or bi-weekly options. But now one of the things I do is I don't sort of gamble. I go way out of the money. So I collect less premium, but at least I collect some premium. Now, for example, give you a case in point of what I did for TNA this week is I have the underlying leaps, but what I did was I sold 40 calls because
sorry guys. Can we put up the chart? Because I think if we see what, that would probably be more helpful as he's talking, if that's possible.
Yeah,
Yeah.
Javed, put the option
The
table.
the table with the price. Sorry, it just so that I can
Option
see
table. Okay. Here we
visually
go.
as well as he's saying it. Like, okay, deep in the money over there versus out. Just a suggestion.
Okay. So deep in the no, it's good suggestion. So deep in the money.
You don't see your screen, Javed. So
Oh, you
change
don't
your
see my
screen.
screen? Oh, sorry, my bad.
I'm saying your document screen, not the.
Oh, my bad. Sorry. Thank you for correcting me. I'm sitting here looking at my options ladder, but nobody else is. All right. Thank you, Arthur. All right. So let's see if I can keep up with you. So Jan, deep in the monies. What strike for TNA?
TNA. I
So
would
go
go
for
some-
leap. I think Shoaib is talking. Go for 6 months or 1 year.
Yeah. So this is 21st January 22, which is fair. So that's So we are sort of looking at 14 months, and what you do is you buy sort of deep in the money calls because of the
So look for delta around 90.
90
above
delta
on the
here
in the money.
in the money right here. 20.
So 20. What is the price for that?
$21.
21 bucks. Instead of 3,900, you are buying the right for that for 2,100 only.
What's the delta? 90 delta. So you're capturing 90% of the move as opposed to 100%.
Yes, so it's behaving exactly as the share. What does it mean? Like share would be 1 delta. Now this will be 90% of that movement, right?
And you're paying half the price because the stock.
Now you're paying from 39, you're only paying 21 till the year of 2022, whatever. So
you got to play with double the money as underlying. Am I right?
yes, so now you hold the same thing like you're holding a share, right? If it goes to zero, shareholder will lose whole 4,000 bucks. The option buyer will lose only 2,100 bucks because that's the only price. But he get the same benefit as a share movement on the upside. And now you can sell out of the money calls on this share every week.
Now, what if you want to do deep in the money calls and you get a sign? What about that? What happens?
Yeah, but the thing is, Javed, if you do that, then again, what you said is you're giving somebody a free lunch. Okay, because when you exercise, because
I agree with that.
money, yeah,
I agree with that. So it's almost impossible for them to give you how much extrinsic in this, but it's $2 of extrinsic. So, whatever you sell. So let's say you can increase the odds of no assignment by selling in the out of the money. Out of the money makes it impossible to get assigned.
Yeah, at the money or out of the money. You want it pushed to go up, right? So let's say you have a one deep in the money leap, you buy it, right? So this has become you are owning the stocks because you are buying it deep in the money, right? So now you can sell for next week, say if 39 is the price, $42, and you can do 2 contracts maybe.
Yeah, you could do double the money. That's why I call it synthetic.
Right?
Bonds.
Yeah. So now you are far away and you're forcing it to make you lose. It has to go up $3 first. And then you will start losing money.
Okay, I'll start typing. I'll leave it on this option ladder, but I'll start typing.
Wait,
So
sorry,
that's
so you
a new way of doing it. I didn't
could
realize.
sell 2 calls off of on that one long call, basically.
Right. And you are giving a $3 a gap also, right?
Mm-hmm.
So first it has to give you a benefit of $3 and then will it start hitting you on the 2 calls.
That's the way to ensure you're never going to get assigned. So you can use all your money on this trade and you'll have double your money because you're only paying half price for selling the same amount of calls. So you're playing with double the amount of capital, theoretically, because you're paying half price, right? So instead of 100 shares, you can have 200 shares of selling calls.
Yeah.
Okay, and without risking assignment because you don't have the money. Now, let's say you did get assigned and you got to come up with shares. You're only paying your strike price, right? So it's not a big deal.
So you get assigned, Jawad. You will be like, if you get assigned, then you are selling a call, right? You are short on the stocks. You will be negative on the stocks. right?
I got
So
it,
you,
Arthur. So if you want to get assigned, make sure that your premium value is higher than the strike that you need to pay, right? That's all.
obviously, nobody is going to exercise their right if it's out of the money.
No, but if
Only
it's
in
in the money, what if you want to do this within the money?
So in the money, you have to give it away every week if you are in the money in this game. You don't do this in the money game. Synthetic call is always out of the money.
No. How about this? Just stay with me for 1 second. I have this underlying at 20 for Jan 22. And then every week I'm going to sell in the monies, like, let's say, what's it at, 39 now? I'm going to sell like 35s every week. But on Friday, I'm going to roll before expiration.
Yes, so you're going to roll.
At 3 o'clock, I'm going to roll on Friday every week.
Right.
So they might assign me anytime during the week or on Friday. If they do, I'm not so worried, because if they assign me, can't I just exercise my underlying calls and get the shares?
Yes, why not? You can exercise your calls whenever. That's the only way you're going to even it out and start again.
Yeah, so I exercise my calls, I have the shares, and I deliver them. Then I start over.
Or you sell it in the market.
The only problem, Javed, is you're giving your
I'm giving the free lunch, right? I'm giving the extrinsic at that point.
So that's why you need to sort of make sure that, unlike holding the equity, you do not want to be assigned with this synthetic covered call.
Because I don't want to give up that extrinsic.
Absolutely.
No, you are not losing extrinsic in one day. All this, you are in a leap call, Javed. How you are losing your extrinsic in?
Because then I'll be paying the strike price, and then all of this extrinsic that I paid for.
You go back to the market and close that call and start again. Why we worried so much about the assignment when it's on the market price? At the market price, your value of option is same as whatever the difference in this stock price. I don't see much difference when we get scared about this assignment. If I get assigned, I go in the market and sell it at the same price and start again. I close the position same way. There's no difference between whether you have a call or you have a stock. They behave same. There's no difference. Why we get scared about this assignment? Just go ahead, do it again.
What would I? Okay, so they want the shares from me. Then what am I doing at that point? Because I don't have the shares.
So you will be short. So if you get assigned, like if you sell somebody call, right?
I'm short the shares at that point.
You are short the shares, right? So you go into the market and close it, buy them. How do you cover your shorts? You go in the market. This is the price. Okay, take it away. Give me my money. You took my money away for short, and you get your money back, and then you open another position. Finish.
But I have no cash.
I think, he means you have the money.
No, if they are exercising you, you are getting cash back. You already short. You already gave the cash away. When you get exercised, your broker already accounts that. Otherwise, they will close their position. You will never be assigned. It's margin call or whatever you want to call it. You have account, then only you get exercise, and you go and close the position. It becomes even out.
The broker will get the cash when he assigns me?
So if I'm short, it means I'm giving them the money from my account, whether it's margin or if I have the cash, whatever it is, right?
Oh, I'll get the strike price when I'm assigned. Oh, you're right. Aren't they going to give me that strike price cash in my account?
Yes. So 39 is the one.
Stupid. Oh, yeah, you're right. They exercised. They gave me the strike price money, right?
Right. So they gave you the strike price money. You kept that money, whatever they gave you. And now you can go back. You get the extrinsic right away. And you go back and you sell the, close the position in the market right away. And you got all the extrinsic. You kept all your premium. Kalas.
So basically, Javed, what Athar is saying, you don't exercise this leap, you sell it.
You keep selling against it.
Yeah.
And you force it to move forward because you're selling out of the money. So if it's not going out of the money, this is your protection, or you are winning every week.
So you always have the cash.
What do you mean by you already have a cash? You don't need a cash. You already bought it. And if you're out of the money, they will assume that cash as your protection. This is same as your covered call.
So even if I'm assigned, there's no problem because they're going to pay me for the strike, right?
Yes, so there is no problem. You just have to liquidate it in the market if you don't want to keep it.
The cash. I'm just going to go buy and send them the shares, right?
Yes. So they will say, okay, you already, like, say you have only 2,100 in your money, right? In your account. You bought one leap call, 2021, 22, whatever we discussed, correct?
Mm-hmm.
Now you don't have money anymore.
Yeah,
and
I
you are
have no
selling
money.
at the money call, right? So
Yeah.
say you sold 40 strike price
And they assign
and
me.
the guy exercised it and you got assigned it, right?
Yep.
So now you will be showing, as if you don't have money, your broker will liquidate immediately in the market and give you the difference, whatever you keep it, if your broker is smart or whatever their regulation is, right?
And
Because
by
you don't have the
difference,
money.
but yeah, I have no money. So what is he going to do? He's going to liquidate the short?
Yeah,
He's
that's
going to
what they do
collapse
it
the
before.
short?
Exactly. Like he will get exercise and he may exercise your position, which is in leaps, and that will even out because you got the shares and then you bought the shares with your call. Broker will say, okay, we have already right for buying it. So you buy at 22 and you sold at 44 and you will have the same amount
shares.
of difference
Shares
of money.
mount up to the same shares.
Yeah, and you have the same amount of profit and loss, whatever you were having. There's no
And then
difference in this.
shares equal shares. So
Yes.
the only difference is, see this extrinsic column? I'm going to have to give that up, right? Like
No,
there's
why you are giving that up? You will start it again. It's 1 day exercise. You are in leaps, right? So the guy has already paid you the commission for that.
But I paid the extrinsic when I bought the call. So when I exercised the call, that extra money that I paid for extrinsic, I lose that money in this collapse of the trade. That money's gone because I didn't get to wait for that time value. So
And that is why you have to be careful that you don't get assigned. I mean, if you get assigned, there's a way out, but you just sort of be smart.
No,
and,
I don't think this is not how it works, Javed. I just may not be able to explain it properly, but I think profit and loss is same at the same time. Extrinsic, you are losing, the other guy is losing, but it's not that you will be losing somebody exercise or you can close it out.
Oh no, Utter, you're right. Utter. Okay, I get it. The person who exercised lost his extrinsic, and I
Right.
lose my extrinsic because we're both exercising. His
Right.
extrinsic will be less than mine because he's shorter term. But
yes,
the key is, so net extrinsic is what I gave up. But look, these extrinsics go lower the deeper in the money you go. So,
Yeah, you are deeper in the money. That's why you're going deeper in the
yeah. So it's not a lot.
money. And you're
Like that's the cost of getting the margin, let's say.
right.
Right? So $2 here is the cost of
This is an extreme case. You can otherwise you can
or
keep
else
your
it never
long
happens.
position.
Yeah. And keep it out of the money all the time. That's fine too.
Yeah.
Okay. Yeah. I like it.
So
I like it. So why are we doing this?
Every day we are doing something. So I don't know.
Yeah, we could have said we did this trade when we were born, right? We all
Yeah,
know.
exactly. So every day I'm losing money and I'm learning something and I'm not consistent and you are consistent. So it's not that, why we are not doing it. There are thousands of strategies.
Yes.
And we have to just develop something consistent. And I'm not in consistent mode at this time. There's so much still stuff to learn around.
Got it.
And that's why I'm like,
Guys, this sounds like, like a sure shot almost, right? I mean, can it be?
If you pick the right strike, if you get too greedy, you're going to get hit all the time. If you
no,
get
we will be hit sometime, but this is what we will roll it out to the next month, right? That's what will
Right.
happen. That's what we don't do. So let's say I'm hitting this week at 40. So as soon as I'm at the money, like I'm selling out of the money and now I'm becoming at the money, right?
Okay.
So as soon as I become at the money, I should roll to the next week and I will get the same premium. It means or extra premium. And I don't need extra money for that. Only problem when we
We need to
wait and
write
we are
this
deep
down.
in the money and then we're trying to roll it to the next week and then premium is not that much enough for the same straight price. So this is like learning curve little bit when to roll it out to keep it safe. Because if this week price is increased, next week's price is also increased, right? So if I roll it out for this week and I'm selling next week, I'm getting more premium for the next week. Does it make sense?
Right.
But you're buying
Right.
back at a higher price. So like if it was out of the
No,
money.
I'm selling first out of the money. So if it's
Right.
40, I'm selling 43, right?
Okay.
I'm waiting. The price is increasing. So Monday price will not, if it hit 43 on Friday or Thursday or Wednesday, the prices would be same as it was Monday or a little bit less, right? Because it has lost 2 days value.
Okay. Yeah.
And now I'm at the money. I had a chance to wait for 2 more days to slide back, or maybe it may go to 45 by Friday. But when I'm at the money, I should roll out immediately next week. So next week, maybe 43 will be more money than this week 43. Correct?
Yeah. Yeah.
Okay, and the
So
other
in
advantage.
net, I will get more credit.
Yeah. Because the other thing, the other good part of this trade is you can sort of work this in tandem with covered calls for TNA. So, for example, what happened this week is TNA showed up and some people sort of ended up losing the profit. So people who sold the 33 calls and now TNA is at 39. Now what happens is, I mean, you lose on that side, that's paper money. But on this side, what happens is you collected the premiums on your out of money, but your underlying leaps, they have gained the extra money.
It's a
Yes.
one delta. It's one delta.
Yes. So you have
Yeah.
the out of money and you are consistently making it increase. So this is more on a less conservative, I would say, but it would be okay. I guess so. I don't know.
Safe. You be safe. And the reason I was obsessed with finding this synthetic margin is because most of my money is in my IRAs, as many of you know. So it's not in my taxable accounts. And ideally, if you want to compound your growth, you want to do it tax-free until the day you have to pay tax, right? So my plan is to grow my IRAs compounded tax-free without touching the money as long as possible, and then only use the money for my expenses later in life, you know, even if that later in life is not at 59 and a half, and pay my 10% penalty and call it a day. Now, if I'm going to do that, there's one rule that all the brokers have. I believe this is an SEC rule. It's not a broker rule, it's SEC, I believe. Is the brokers will never extend you margin in your IRA accounts, your retirement non-tax accounts, non-taxable accounts. So I didn't want that to stop me because I wanted to use more money with the money I have or make my money go further. I wanted leverage. So this is a backdoor way to get leverage without the broker stopping me from using more leverage in my account. I wanted more juice for the money I have. This will give me more juice. As Arthur pointed out, I'm paying $20 to control a $40 stock. So I can sell double the amount of calls on a simple basis for the same amount of money in the account. So if I have 500,000, I could sell $1 million worth of calls.
Do IRAs allow covered calls against leaps?
Yeah, I do
IRAs
it.
allow everything except naked calling.
This is the good thing that you cannot short the stock in IRA, but you can sell the calls the same as, and I do the same thing. I'm in the IRA. I don't do anything on my other personal.
That's
I
good.
sold
That's a good
covered
point.
calls, but not against leaps. I didn't know that. Okay, that's great.
You could do everything in the IRA except naked call and put selling. You cannot do naked call and put selling. But everything
No,
else.
you can do the naked put. I do the naked put. I don't do the naked call, but naked put is allowed, not naked
Oh,
call.
naked put. Yeah, that's like a married put, like cash covered put.
Yeah, it's like a cash
covered
covered.
put.
So obviously, if there's no margin, then cash covered is your naked covered position.
Yeah, that's true actually.
And Arthur has a very good point. So another synthetic way to short in your account, which I never thought of until recently. If you want to short in your IRA, just sell call spreads, right, Arthur? Is that how?
Yeah, vertical.
Yeah,
So
and make your spread very wide. If you want to really short and get maximum exposure, make your out of the money call way out, right?
yeah,
Then
you can
get
increase
full
the number
exposure.
of shares, and with the spread, your margin requirement is less.
Yes.
So synthetic way is okay, 1:1, right? This is the best way because you're not losing anything.
Yeah.
But if you wanted to increase the number of contracts and also be protected, you go a little bit far away rather than add the money.
Yes.
And then you multiply your contracts with the spread.
Yeah, that's a
So,
great way to short.
yeah. So now, ideally, in a synthetic covered call, you can only buy one and short one. But with the spread, I can short 2 or 3 based on how much money more I have it.
Exactly.
Right. So I will go further out. And if I'm doing add the money one shot only in a regular synthetic, I may go 2 or 3 points out, and now I can sell 3 contracts.
So no limitations in your IRAs. The only limitation is you can only do all of this if you rolled your 401ks over to your IRAs, or if you started a new IRA and put $8,500 a year. I think that's the limit on IRAs and Roth IRAs.
Roth IRAs, I think 6,000 maximum.
Oh, 6,000 max. Okay, 6,000
Yeah.
max. So, or you can roll over your 401ks after you leave your job.
Yeah.
Yes.
No, I did my within the job. I rolled over my 401k. My company allows it. So I
They
think
allowed
it's
you? Wow.
Yeah, I opened an account and they told me, okay, give us the name, because
That's
my company was
incredible.
not giving all these option of playing
That's
call and all
amazing.
that thing. They have their own. So they transferred the money. So I don't know, but I think it's company to company rule, I guess.
Yeah, that's a huge benefit. If I ever get a job, I'm going to ask for it big time.
Yeah, but again, Dr. Javed, not all companies will let you do, but some will, and
Yeah.
also in some cases there's a age stipulation, but hey, you get to there when you get there.
Yeah, that's incredible. That's amazing flexibility. Amazing
Yeah.
flexibility.
Because the thing is, I mean, if you look at the 401k and they give you like the 6 options, and
Yeah, only mid cap, emerging market, and
yeah,
all that.
yeah,
Portfolio
yeah,
fund.
and you
Even
see,
if we have
you
a brokerage, but that brokerage charges $12 for one transaction.
That's
Who is
crazy.
going to do now?
Crazy.
You know?
It's still worth it. I used to pay like $40 a transaction.
Yeah, it was before,
Still
but
worth
now it's free outside. They should
Yeah,
come out with
they
some
should.
better system. That's why I closed my other brokerage of the company and then moved it over once I know that they will allow it.
One more thing I want to point out while we're on this retirement account topic. One thing I learned, which almost nobody knows, if you guys have the benefit of having a cash balance pension, not a regular pension, a cash balance pension, then look into your plan documents. Most of the time, they will allow you to roll that cash balance pension over to an IRA, which will allow you to do everything we're talking about. Once you leave, I rarely, Athar, do you guys have a cash balance pension in your company?
No more pension is like
I have
when I got it
one,
was
and I have to do something about it. I have already left, so I guess I will roll it over to IRA then.
They used to give you 5% a year on that once you leave.
Right.
So if you can beat 5% a year doing whatever you're doing here, then there's no reason to stay in your cash balance pension the way it is.
I figured they're guaranteed, and
I mean, guaranteed for 5% a year for the rest of your life, and for your spouse too, until you die, and until they die. But that's a huge opportunity cost. It takes 60 days to roll it over. Your spouse and you both have to sign the papers because they're entitled to the money too. But the money does come through. I successfully rolled over. So very few people know that. They never advertise it because the last thing they want is to give you that money back.
actually, I think it is in the documents. I didn't do it because I thought 5% guaranteed was good. I mean, at that time also I couldn't trade, so.
Yeah, no, it's in the documents in black and white. I found out because I read the documents. There's 5 options on your cash balance pension. The last option is roll it over. Yeah, they don't advertise it.
Yeah.
True. And even when you ask them to do it, they make it hard. There's a lot of paperwork involved, and it takes a long time. But They do get it done. They're obligated to. It's in the documents.
Okay, yeah, my amount is small. JP was the only one that did the cash balance pension. And,
Yeah, it's rare. And
Yeah.
even my bank got rid of it after I got hired. I was vested, but so anybody who got hired
yes,
later,
they don't have it now.
They don't have it. They don't have it.
Cool, but this is good. Is it possible, and I'm happy to write it down, if is it possible to kind of, write down the bullets for a
Yeah.
sample trade, like, the one that he was talking about? So this would be Jan 21. Like if someone was to do it now, right? Like for example, I got assigned, so I'll do it Monday. So Jan 21, 43 call I buy. No, I sell the covered 43 call, but I buy an in the money leap, is it?
Yeah, in the money 90 delta leap.
Right. Okay. So I would be buying something like, I don't know what, like maybe 38 call and selling 43. Is that?
Timmy, you have to break down the extrinsic and intrinsic prices on the leap, right? Because we don't want it to pay extrinsic price. We wanted to keep is as much close to intrinsic as possible. So this will behave exactly as stock price.
100%.
Right? So we will look at the prices, whether it's 90 delta or 95 delta or whatever is closest.
Yeah.
To that where your extrinsic is almost negligible.
Well, the higher the delta, the lower the extrinsic, right? So
yeah, that's true. But sometimes the volatility also make extrinsic, right?
Right.
So the extrinsic comes from the volatility, which you don't have a control. So today it may be zero, tomorrow there could be extrinsic in that price. It can rise up, right? So just telling you.
One thing around what Athar said, if everybody can see the ladder, right? Right now?
Can you convert that extrinsic, Javed, if you don't mind?
Yeah, here's the extrinsic column right here.
Yeah, change it into the extrinsic. Oh, this is extrinsic?
Yeah, this is extrinsic. One thing, Athar, about what you said, and it especially holds for TNA, these spreads explode when you go too deep in the money.
Yeah, so that's why this is another thing where you have to.
What do you mean explode? What do you mean that?
Like this is a $4 spread.
Like bid and ask prices, because there will be less players in that, right?
Oh,
and if you don't pick up the round numbers, you will find even lesser people on the odd numbers, like 22, 23. You'll find more people on 20, 25, something like that.
Oh,
okay. So
you have to look at the open interest, right?
Yeah.
So open interest kind of thing to give you that there's be a little bit more liquid.
Never do this on a market order. That's the warning for the day. You will get killed at a $4 spread. They will cremate you, and it's legal to do that too. When you're buying this, they're going to buy you at the ask, which is $4 higher than the bid.
Jeez,
Yeah, they'll do it, and it's legal to do that. They will do that to you. So never put a market order for these wide spreads. You'll get absolutely fleeced. You'll put the order in, you'll buy your calls, and then immediately your P&L will be negative, massively negative, just for executing the trade. Because you'll be marked in the middle, but you bought at the ask. So watch yourself on that. So there's a trade-off there. You want very low extrinsic, but not so low extrinsic that you're going to get creamed on execution. This is like a $5 execution right here, $5 spread. They can fill you anywhere inside that. And if you put it in the middle, you might not get filled, because what Athar said is there's not enough people to take you out in the middle of that. So just watch yourself on that.
So it's like the
Usually,
Goldilocks.
you have to decide, like look at the extrinsic on the 20 strike price and 10 strike price.
Yeah, that looks like a decent spread right there. It's a $1 spread.
Right, and you have two extrinsic, and if you go for deep in the money to make it zero, $10 strike price, you are saving how much?
Not much, very much.
Right, you're saving one, but you are giving up 10.
Yeah, there you go.
You have to find a balance where you don't want it to save some extrinsic, but at the same time you're paying more.
for that difference.
So it's the extrinsic get low, keeping the spread, and you want to get one where the spread is relatively low, which implies that the liquidity is better.
Yeah, closer to add the money so that you are not paying too much if it goes down. Right? So I'm not saying add the money exactly, but not saying all the way to the 0 or 10, which would be like buying the stock at the same price.
So your rule of thumb is 90 or better delta, 90 to 95 delta, generally speaking, for the most part. No?
90 would be around where your extrinsic is very low, right? And that's what you will be losing at the end of 2 years. That will be gone away from you, right?
Right.
So bring up your extrinsic, and then you are how far deep you are, because you don't want it to cover for the low side of the trade, right? So if the strike goes to 10 tomorrow, you are not losing up to 10. You are losing only up to 20. So if we are buying a stock at 20 strike price, my loss is only up to 20. After that, I'm not losing anymore. So my protection is already defined up to 20 strike price for 2 years.
Yeah.
You get my point? Like we were discussing with the Ursula on other call, we will keep on buying a put for every week or whatever. This way, 2 years, my bottom line is this: I'm not going to lose any more money below the 20 strike price, because that's where I bought the call. So anything below, I am not losing for 2 years.
And 2 years, that's, I know you guys mentioned before, how far out, how long should this, I guess you call it a leap? How far out it should be? You said a year, 2 years?
No, after a year, you're going to revisit this trade and maybe go for another 2 years. You will close this whole thing and then start another kind of thing.
Achha, so you're buying the call for 2 year expiration.
Right. So you are not losing any extrinsic on this one, but you are keep on selling covered call at the money or out of the money, and it keeps on rising. And after some time, you will say, okay, now it's done. Either you have to pull the plug, you have to get the strike, you have to exercise your thing if you're still in the trade, or you move to the next 2 years leap, and instead of 20 strike price, go to 40 strike price now. Yeah, because more you stay and more it goes up, then more you are in the risk zone now. Understand? So if 1 year later on this becomes 60 or 70 and you are still holding at 20, so you have a risk till 20.
Yeah.
You can lose all this 20 again, right?
Interesting.
So just an idea for protection kind of thing. Like if we are talking about protection, this is a protection for 1 year, 2 year, and you can continue to do the trade without worrying about the protection every week.
So just to understand this further, what's the blow up, as Javed calls, when it's blowing up? What's the worst case scenario with this sort of scenario, basically?
The blow up is $20. You are going to lose your $20.
That's it. Okay.
On a $40 TNA right now, if you wanted to say that. Somebody can lose $40 completely. You are going to lose maximum $20.
Okay.
Till 2 years.
Yeah. Makes sense.
And then you make your $20 back by selling more premium.
Yeah, exactly. So you are selling out of the money at the money call. And
you just keep selling.
And you roll over every week because of you guys saying not a
yeah, so then you are selling every week, just like a covered call. So this deep in the money makes like you are buying a stock with less capital, and then you are doing a covered call. Just like a regular covered call, at the money, out of the money, or whatever.
The concern is the rolling over part, the expense of buying it back to roll over, given whether the market is up or, I mean, if the market's going up, you're going to end up paying a little more. Although, yes, like you said, there's theta decay and all, but depends on, there's multiple factors, right? So you could also be buying it back for a premium to then roll it over and of course getting a credit off of that. But the hope is you keep collecting your net positive weekly, right? But
Yes.
sometimes you won't be, or many times you won't be. It depends.
You have to close it in loss, but if it's going up, your stock value is going up too. So one side, if you are getting loose, one side you are gaining all the time, right?
On your long
on your call. So 22 will become 24, become 26 if you're going to lose it, right?
Yeah, right.
Since you are deep in the money, it is behaving exactly as the stock.
Yeah, 1-to-1, right? Okay.
1-to-1. So if the TNA becomes 44, this 21 will become 24.
Yeah, true.
And then you will lose the money if you're selling somebody at 44 on that amount for that week. And then you can roll for the next week if you're about to strike. That's kind of, you are, moving forward with this stock.
Okay. Well, thanks.
And again, again, long term, what you can do is TNA right now is 39, and depending on how the market is, if it goes to 60, you can roll your 20s to 40 and get some money out.
Yeah, so you can pay exactly. Like protection wise, think about it. Right now we are thinking 20 is the protection, but 90 delta at 60 would be 40 at that time.
Mm-hmm. Wait, so hold on. Can you just, I think that was Brother Mustafa who said that. So you're telling me, so you have a scenario, I have a long call, a 20 call, and then the market, it goes up from, let's say 40 to 60. So that call, you're saying I sell that and buy another one basically for the same.
Yeah, because yes.
Yeah, it closed up because exactly. Go ahead, Mr.
No, I mean, basically what it is like the stock. So if your 20 option is trading at $20 now, and when TNA goes up to 60, it'll be worth $40. So what you can do is you pull the some money out and
buy a long.
Now you're
you sell it for a profit, right? You make money on that. You sell that call because now that $22 you paid is worth $25, and then you buy a 40 call for cheaper.
That one, they wanted to win the game.
Yep.
Yeah. I see. So and that's different than, and this is a side note, which I don't know, we can talk about this here, but rolling up, I'm still confused on the rolling up part. When, like Javed, I know you've mentioned that many times, you roll up when the market goes up, but your roll up means you're buying back your call that now
selling at the same time, buying back for the current week and selling at the same time for the next week. That's called roll up.
Oh, that's not rolling over?
Yeah, that's rolling over in one trade. But you are just this week. That's what I know from an option rollover. When we call rollover in option,
right?
That's exactly the term. You close the current week and you open for the next week or next month, whatever the next target is.
Yeah, that I understand, but maybe my definition is wrong. Then rolling up, which is I thought is different than rolling over, is let's say it's the same expiration. You just roll up. You go up on the call, on the covered call. Just buy this one back and go up and sell a higher up covered call because the market went up. Isn't that what rolling up is, or am I mistaken?
I think no. This is also rolling up. You are closing up that previous call and you're opening up a new one, but different, same week instead of next week, right?
Yeah, same expiration, just up.
Change the strike price. So you closed over one strike price and you opened another one, which we rolled up. Like from 110 to 115, he moved up. It means there is no extrinsic over there. And he wanted to grab some more extrinsic, which would be add the money or closer to add the money. So he's rolling over. He's rolling up.
Yeah. So, but he roll up means
simpleton like me, when I roll up, like if I'm going from 110 to 115, if I'm not paying the whole $5 to roll up, if my cost is just $3 to roll up, then those two are the extrinsic that I'm capturing, and that's how I decide to roll up. It's seldom that I roll up, but if sometimes you have to, and that's all that there is about rolling up. You can roll up within the same expiry, or you can roll up to the next week as well.
Well, that's what I'm saying. But if you roll up in the same expiry, aren't you spending more money to buy back that call and then to sell another one further up?
Yes. So just like I said, you instead of, because you're rolling up $5, and
Right.
if you're paying just 3 to do that, this means, you're capturing 2.
Okay, I got to get better at that. Okay.
Yeah.
Taking more risk. So when the stock goes down and you do that,
Right, exactly.
you lose
So
money in your account. Your
Sure.
whole account value goes down. That's the risk you're taking by rolling up. I like Arthur says, I roll up and I roll out. Actually, I do both. So I'll try to capture more by waiting a little longer. That goes back to that question somebody asked, why do I go out so far? Sometimes I go out so far because I screwed up and I lost money in the account. I got too aggressive. So that's like me fixing the account. I'm just gonna, I used to tell everybody I don't lose money, I just lose time. So when you see me roll out a lot, one of the reasons is I'm just gonna give up time to make my money back.
So here's a question to you, Javed. When is your exit in this? So when your extrinsic becomes 0, or this should be for everyone? What is the point in staying in the trade when the extrinsic becomes 0 in a call?
Oh yeah, that's good. So I follow your guideline actually. What you guys discussed this on an earlier call. I think I've been targeting like 80 to 90% of the money was made in the extrinsic. I mean, what has been the guidelines you guys threw out? I target kind of 80 to 90% of the money was made in the extrinsic. What guidelines have you guys
Because
discussed?
we are all waiting for the whole week, right? We are all waiting for the whole week to close and do that, and sometimes it get killed just waiting for another 2 days.
Yeah, you don't want to, there's the risk reward is not there. I know out there specifically you brought this up, and I learned from the call that you guys had. There's no risk reward balance in your favor if you've made like 80% of your money. Why are you waiting for making the last 20% and risking losing all of the profit you made plus all of whatever stock hit you're going to take after that? Why are you, because you're long the stock. Let's not kid ourselves. We are all long the stock in this trade, and you can lose potentially all of the stock, potentially. So why are you going to risk losing all that money to squeeze out an extra 20% or 10%? So I wait till I get like 80% of my money, but I would love to hear other guidelines of how much of the extrinsic you
No, so how do you open? Like if you are close, you wait for the opportunity, because this is question coming continuation, right? So you made your 80% in the cover call, and if you are deep in the money, you have to look for the extrinsic value, right?
Oh, where do I get it from? Okay, good question. All right.
So
yeah.
So if you close, if your extrinsic becomes like 0, then basically your covered call and your stock is 1:1. So whatever gain is negated by your sold call. There's no benefit to you except downside only in this.
Yes,
in
100%.
This, right?
So
then you should be closing all your positions, selling the stock as well as the covered call. Then only it will become 0. Otherwise, if you keep the stock open, then you are again open for the downfall, right?
Yeah, very good question. I think this question comes up a lot, and people wonder what am I doing? So number one, that happened a couple of times to both me and JJ, because we're both deep in the money guys for long term, like at least 4 weeks out. And people notice that if you look at the list, right? So me and JJ, that happened to us a few times this summer. Every time that happened, we made our money early, right? So we can all agree that our money was made early. But we didn't stop playing the game, which Uthar says we should stop doing. We should close out everything. Okay, option one would be close everything out and do nothing because we made our money. And maybe wait till the expiration or something, right? And then
I don't know like how to define that opportunity. I know the time is the opportunity, but time is not giving you opportunity in this trade now. So you have to
existing trade. Yes. So you close the trade.
Yeah. So you have to find something else for the opportunity.
100%.
Roll up.
100%. So what we used to do is what Uthar said. We rolled up. So we made our money early. We played. You can keep your risk the same if you hold the same delta when you roll up. Because remember, our delta got way deeper in the money. It became closer to 1, as Uthar pointed out. But if we started with an 80, Then when we close that call, we're going to roll to another 80.
Exactly.
That would keep our risk the same. Now, if we have the benefit of time went by, then we'll roll out again. Like, let's say I had a 4-week out. This is what happened multiple times through the summer. Specifically happened. We had 4 weeks out, but the stock went up so fast that our delta went to 1. There was 0 extrinsic left. And we rolled, it happened 2 weeks in. It happened 2 weeks in. So we already got 2 weeks of time value plus all that extrinsic. So we just rolled out another 2 weeks beyond that. So we just kept rolling out every time we made
But now at that point, you're not in the risk. This is what I'm trying to figure it out. That's where technical comes into the play. Then obviously it's not going to keep on going up, right?
No.
So you made money in 2 weeks. It means it has moved too fast, right?
Yep.
And now you are again joining at that time when it's already moved fast. Then your reward looks like technical point of view is less now at this point.
Well, he's rolling up too, right? Up and out?
Yeah, like what first of all, you're right. If we technically speaking, even if we have the same delta, we're taking more risk because it's a steep move.
Yeah, it's out of the ball. That's why you made your money earlier, right?
Yeah.
Because
It was
moved
an
fast.
unexpected move. Yes, unexpected
Yeah.
move. So we're taking more risk if we do that. So what was that, Aziz in the background? Aziz?
Yeah, that's me. Yep.
So we also try to buffer that by rolling out. You can keep a deeper delta by rolling out, because then you're collecting more premium, but for the same delta or a little slightly higher delta, not the old delta. So let's say I had an 80 delta and then I made all my money. I might go for a 90 delta, but roll out and maybe roll out even a little further,
Okay.
So that way I don't have to give up a lot of risk given the technical.
So you are always in rolling up and down if you are long.
Until
long
it looked
play?
bad, until it looked really bad. So when we went to 160 to 175, I was like, fuck this. I don't see anything good. Everything looks too risky. So I just didn't take position for a week. That happened to be the week that we fell apart. So sometimes I just say, fuck it. I don't like it.
Yeah, I know it's psychologically to me. I don't want to look at computers and mind is too much into this and that. And you just want to clear it out. That's why like sometimes people say, just close out everything and start fresh again.
Yeah.
That's make much more
I didn't find anything I liked.
sense.
Everything looked ridiculous to me. Going up 40 points in a few days was insane. So I just said,
Right.
I'm going to wait till I get premium. There's no good premiums out there. So
I think like you two were saying, if there's a lot of stuff sitting in that portfolio that is still open, sometimes that
Yeah.
keeps me from getting into newer trades. So I like to sort of clear it out if there's not much left, like not much money left.
I totally
So that
agree.
I can get into new ones, just like you said, from a psychological point of view, because I just feel I have to manage these. So
It takes a lot of bandwidth. It takes a lot of bandwidth.
yeah.
So I have one position, so I don't have to manage anything. So my one position, I'm either in or out. And maybe now I'll keep like 10%. So in times like that, I might have had a 10% position when I went to 175. Then I still would have been involved if there was more upside, but I wouldn't have so much exposure that I'd be exposed to the crash in any meaningful way. So when it goes like that out there, I'll probably reduce my positions too and not have a 100% position at those times. It's a very good question. When you make your money early, what do you do? Do you hang out? Do you take less position? Take less risk? I totally believe the technical picture when it's steep is dangerous and it does always come back. So, you have to be ready for that. We just saw that recently. You have to be ready for that pullback. Or else you give up all the gains you made. So I agree with you. So I think we're like 2 hours in, so that's probably a good place to get trained. So I'll share the Word doc with everybody. If anybody ever wants to hold these calls, just let me know, and I'll put you on the calendar here, and I'll give you the admin for the what do you call when you hand over the control of the Zoom. I'll give you the control of the Zoom, and you can manage the call. It doesn't have to be me scheduling the calls. So feel free. If you ever want to call, I'll just give you the controls and you can manage the call. I think the more we do this, the more we learn from each other. And it's already shown. It was a spectacular summer for many of us. And I think we have many more seasons ahead of us, inshallah.
Sure.
Yeah.
Javed, can you share the recording?
Yes. So I'll save this and I'll share the recording online too. I'll send you guys the link.
Great. Thank you.
Okay, good. All right, good. Have a good weekend, guys. Talk to you.
Thank you.
Okay, thank you.
Thank you.
care all.
Thanks,
You
guys.
too. Thank you.
Thank you. You have a wonderful weekend.
Bye.
Thanks, guys. Bye.